Risk sentiment is deteriorating into Wednesday as escalating Gulf tensions, higher oil prices, and elevated global bond yields challenge the recent optimism across equity markets. Wall Street closed lower on Tuesday. Semiconductors led the retreat, with the Philadelphia Semiconductor Index falling 5% as rising long term borrowing costs placed renewed pressure on highly valued technology shares. The U.S. 30-year yield briefly reached its highest level since 2007, reflecting concerns around persistent inflation, fiscal deficits, and increasingly heavy corporate borrowing to finance AI investment. U.S. equity futures remain modestly softer this morning. The geopolitical focus remains firmly on the Gulf. The UAE has halted trade and financial dealings with Iran following allegations of Iranian missile attack, which Tehran denies, while France is expelling two Iranian diplomats. Continued uncertainty surrounding the Strait of Hormuz has pushed oil higher for a fourth session. A reported draw in U.S. crude inventories and particularly large decline in diesel stocks are adding to the supply concerns. Oil's advance is supporting energy shares, but reinforcing inflation worries across bonds and the broader equity market. In FX, the dollar remains close to multi-month lows despite the broader risk aversion, with softer U.S. employment and activity indicators reducing expectations for another Federal Reserve hike. For Wednesday, UK CPI is the main European event, followed by final Eurozone inflation. The principal global risk event is the July FOMC Minutes, where markets will assess the Fed's tolerance for oil driven inflation against mounting evidence of softer U.S. growth. That's all for now.